Welcome. This is the July monthly webinar from Principal Wealth. I'm Julina Ogilvie, partner and wealth advisor, and I'm joined by Bob Paolucci, our CEO. Happy summer.
Happy summer.
We are here.
Thank the Lord for this weather.
Yes, we are more than halfway through the year. We titled this month's webinar Half Year Highs, and I'm going to share my slides so that everyone can see the lovely visual that Kate put on here with not only the rocket, the AI generated city, but with all of the balloons that are going as well.
The fireworks, all that stuff.
Mm-hmm.
Very, very thematic for this.
Very thematic. It is a very good time to be in the market despite all of the anxiety that we continue to hear about.
Yeah, agree.
Yep. And so we are going to, as always, our agenda is talking about the markets, go through the economy and policy, some of the market anomalies, and end with everything else.
Sounds like a wonderful plan. Let's get into it.
All right, let's go. So let's start with the markets. And this is the mid-year market check and basically just highlighting the fact that we're going to talk about this, but everything has gone higher.
Yeah, you have the NASDAQ leading the way. It's off a little bit from its high, but it's still up just about 20% so far for the half year. You have outside of the US, so the ex-US index, so the entire world minus the US is up, a little over 13%. The Dow is just shy of about 9%, and you have the S&P 500 just shy of 10% for the year. So generally speaking, we have full year returns in a half year. That's pretty good. If the year ended today, I think everyone would be quite happy with their results, but it's not over yet, Julina.
No.
More to come.
More to come. And I think just a continuation of the fact that, a lot of these broad markets are near or at all-time highs. Here are some statistics that we can reference.
Yeah, I think a lot of investors in general, even professionals, really forget that the second quarter, of which we just finished ending June 30, we had the second highest quarterly return in the past decade on the S&P and the NASDAQ. The Dow had its best return in quarterly in 4 years. We had 24 new all-time highs for the S&P in the first half of the year. As a first half return, that's the best first half return in 5 years. And there's depth here. The S&P 400 mid-cap index had its best quarter going back to 2020. And the semiconductor index, all those chip makers, the index rose 88% in Q2, which is a record. It's best quarter ever in history. Now, some of the skew is because in March, you had some pricing out, you had some declining because of the onset of the war. So there's some rebound in there. But it is what it is. Those are phenomenal numbers.
Yeah, absolutely.
Oh, right. Yeah. Yes, everyone. Julina now has access to the soundboard. So get ready for this fun.
Get ready. But very, very good reasons to be in the market. We should be celebrating.
Yes.
But let's dive a little bit more into the market and talk about the S&P 500 and sort of the transition here we've seen with performance.
Yeah, so I think everyone is familiar with the Magnificent Seven. It's the top 7 of the S&P 500. It's NVIDIA, Apple, Alphabet, which is Google, Microsoft, Amazon, Meta, and Tesla. So the Mag 7 really has carried the market for years. And there are times where it takes a breather, and that time has been the past 6 months, at least relative to the rest of the market. Yeah. So what you see here is the depth of the market. The remaining 493 stocks have sort of picked it up a little bit, while the Mag 7 took a breather. Now, what's fascinating, and we'll get into this a little later, is the earnings of the Mag 7 have grown dramatically. Mm-hmm. And if you combine the lack of price increases for the first 6 months with the dramatic rise in earnings, you have a result that looks like something on the right. You have the lowest PE ratios for this group of stocks that we've seen in a very long time, and in some cases ever. So not that we're telling anyone to run out and buy anything, but we here internally are very optimistic on the Mag 7. Uh, the highest quality companies on the planet, they're very liquid, access to capital at no spread to treasuries. Those are real companies that you want to invest in, especially with their rate of earnings and their projected rate of earnings going forward. We are in awe of it. So, generally speaking, if you look on the left, very high PE ratio levels, usually not that attractive.
Right.
All the way on the right, which is where we are now, low PE ratios. Not to say it's a perfect valuation measurement, but it's a good indication, especially when you have high growth companies at low ish prices. Uh,
Yeah.
there's very likely some upside from here.
And I think that this is a very important point because when we have these markets hitting their all-time highs, there is always the question of, well, should I still be in the market?
Right.
Or what is the opportunity going forward from here? And so not only is there an opportunity from a valuation standpoint, but then you talk about some of the cash flow.
Yeah, I mean, if you look at many of the Mag 7 members, they are hyperscalers. What that means is they are spending a lot of money on AI and ways to become more efficient. And they know that the benefits don't show up tomorrow, they show up down the road. So here are estimates from analysts, which come off of the back of the company CFOs themselves. And what you see here is for Alphabet, Meta, Microsoft, and Amazon, the forward future free cash flow estimates are um, just about off the chart.
Hmm.
So if you think about valuations and where they are now, and if this happens, uh, earnings go way up, free cash flow goes way up, um, and that's a very good thing.
Very good thing.
Yeah,
Yeah,
yeah.
absolutely. Another interesting point that we wanted to make, that I think is so important. There's so much criticism over the decades of who's been participating in the markets, and we've seen a transition here over the last 5 years.
Yeah, the transition is the bottom 50% of the net worth uh, cohort have actually participated and benefited exponentially since COVID,
Yeah,
right?
yeah,
A 600% increase in household equity and mutual fund ownership. That's the largest change, percentage change of any cohort, which is wild and also very good to see.
yeah,
So
yeah.
I think you'll hear more from us as we get underneath this data,
Hmm.
who is participating and how. But that's a very good sign for this country and the people in this country.
Yeah. And I think it's an interesting time as the Trump accounts are being introduced. We're a huge fan of financial literacy. And not that I think $1,000, when a child is born is gonna make their retirement, but just the fact that kids are going to be educated at such a young age, I think it's going to be fascinating to see what that effect looks like.
Yeah, if you're exposed to stuff sooner,
Hmm.
generally speaking, whether it be good or bad, it becomes a little bit more relatable, a little bit more interesting,
Yeah,
and you have more experience, right? So at the end of the day, if you want to increase financial literacy, it's exposure first.
absolutely.
That creates some relatability, some interest, and it's on from there.
Yeah, absolutely.
Yeah.
And another transition over the last 5 years that we've seen is just how the top 10 constituents of the S&P 500 have shifted.
Yeah, I mean, this is really looking back to 2020 versus the end of June of this year. There's always change at the top, right?
Yeah.
The S&P is constantly changing, driven by market forces. And what you see today versus 6 years ago is, number one, there's a little bit more concentration at the top of the market. Um, a lot of that comes from just exponential growth,
Hmm.
and research and development and advancement by some of the leading companies, their ability and their willingness to take risk, um, and to create new things, processes, ideas, concepts, platforms, technology.
Yeah.
Number one. Number two, you're starting to see a theme here where you look on the left, starting at the bottom, you had JP Morgan, which is still an enormous company, Visa, Berkshire Hathaway, Johnson and Johnson, in essence, sorry, technology companies.
Correct.
You look on the right, Really, I could say NVIDIA's tech, Apple is tech, Microsoft is tech, Amazon, even though it's a retailer, it's tech.
Hmm.
Google is tech, AVGO is Broadcom tech, Google is tech, the second share class, Meta is tech, Tesla, although you view them as cars, it's tech,
Yep.
and Micron is tech. So,
Fascinating.
technology continuing to lead the way with its advancements and its um, research and development and its, capital following it and willingness to lend and all that fun stuff. So,
Hmm.
yeah, the market is becoming a little bit more tech heavy. The cute thing that the board of governors at the S&P uh, they try to pull off is, they'll call Google media or communications. They'll call Meta communications. They'll call Amazon a discretionary retailer.
Hmm.
So therefore, technically, they are not in the tech sector. But if you spend more than 1 minute understanding their business, you'll understand that now the top 10 of the S&P are all tech companies.
Yeah.
So just something to be mindful of.
Right. And it'll continue to change.
Yes, it will.
Yep. And as we are now have entered the second half of this year, let's spend a moment to talk a little bit about some of the possible short-term return.
Yeah. So these coincident indicators and coincident charts, they're fun to look at. They don't predict the future, but they are fun to talk about. So, you typically have the summer in the markets defined as a low volume, choppier period, right? There's not a lot that happens in the summer other than maybe incrementally higher volatility, mostly due to lower volume. And then what you have coming into the final quarter of the year, usually around September, there's repositioning, rebalancing, tax loss harvesting. A lot of foundations and endowments do their year end rebalancing in September. A lot of active mutual funds do the same thing. So you just have a lot of churn, which does create more volatility. And it just seems to be done usually in the month of September.
Right.
September, usually not the best month, but that usually leads to recovery in the fourth quarter. So I firmly believe that Q4, October, November, December, is usually quite positive because of the churn and rebalancing that comes from sometimes August and September, but mostly
Right.
September. So right now we're in July,
Uh-huh.
and shockingly, over the past 10 and 20 years, July has been quite positive. Over the past 50 years, quite positive. This chart shows for the last 11 years, we've had a positive July. Fingers crossed for this month.
Right.
Maybe we will, maybe we won't. But that's a pretty long win streak for a
Yeah.
month, a summer month, mind you.
Yeah.
So
Absolutely. And I
yeah.
think,
Maybe it'll be Christmas in July. We'll see.
and on that note, I know you were excited about the title of the last one about starting with a bang. So
Yeah.
I just
Well,
wanted
it's
to
4th of
reference
July,
that.
fireworks, all that stuff.
All that stuff. But I
Yeah.
also do think it's important. Part of the message here is don't be surprised if you see a little bit of volatility in your portfolios, right, later this summer, because it is common. And I think that that's an important thing to address because the market really has gone up in a pretty straight line this year
Well, it's
since
normal,
April.
right? If you own a boat, or if you're sailing or you're on a power boat, the waves are unavoidable, right?
Right.
Choppiness of the waters is permanent.
Yes.
Unless you're on a lake. But if you're out in the ocean, that's just part of the process. Volatility is part of the process.
Exactly.
It doesn't mean much other than money is changing hands at various prices.
Right.
And you have us to rely on for, when things get much more volatile, if there's repositioning that has to happen, or if there are, sales that
Yeah.
need to be bought, that's our job.
Yep.
So, volatility is, you just have to ride some of the volatility wave to enjoy the benefits of, great returns over a very long period of time.
Right. It's part of the ownership.
Yeah.
And I think one last point in regards to the market is we do have to address the midterm elections and some of the expectation around market return.
Yeah. Look, historically, in a midterm year, we would not have the results that we have so far year to date, right? So far year to date, we've had some phenomenal returns. Now, look, what's generating the return? Earnings, number one. Number two, it seems to be, at least economically, a very pro-U.S. Scenario that we're in. We do have the full benefits of the one big beautiful bill, the tax and spending bill that was signed last year. The real benefits are showing up now. So we have a strong economy. We have inflation that's sort of in check. We have above average economic growth. We have full employment. We have a huge demand for corporate bonds from the capital markets, which injects lots of cash into the hands of companies that are willing to borrow it.
Mhm.
Um, they tend to borrow it and make a lot more than the rate of interest they pay on those bonds. And that creates much higher earnings typically. So we have, are we running on all cylinders? Yeah, I think this is as close as you can get to running on all cylinders where the Fed doesn't have to do anything. And we have a good employment picture. We have a decent inflation picture. It's really a f- foundationally sound setting for the capital markets and the economy. And when you have that, this is what happens. Typically in midterm years, um, you have more of a muted market until the election is over. So you
Correct.
can see on the left chart, on the right side of the left chart, you could see November. You typically see, whether it be all years or specifically midterm years, you see it start to move up and to the right pretty dramatically. It's
Correct.
almost like a rubber band was holding it down, then you
Yeah.
let it go and it spread.
All that uncertainty going into it.
Yeah, you have a rule book.
Mhm.
Whether it be a new rule book or a rule book, at least now you know what you're looking at.
Yeah.
I think things are so good that the market is just kind of looking through the midterms. Look, do I think we'll get some chop August, September? I do. Do I think we'll have a nice year-end rally? Um, I do. I can't see why we wouldn't, unless there are some unforeseen geopolitical events.
Yeah.
But the setup is actually pretty good here.
Yeah, and I think one last point on this slide that I personally love is that when you look at the average one-year return of the market after the midterm election,
Mm,
the return is an average of 15.4%, which is almost double the
yeah,
average across all years.
yeah, it's shocking, isn't it?
Yeah,
Yeah,
and I think people are surprised when they see that because
yeah.
when they
Now,
hear midterms, they just hear uncertainty and market volatility in general.
yeah, so very, very specifically, it is the third year of the presidential cycle. The
Mhm.
4-year cycle, the third year tends to be quite good.
Right,
Yeah.
exactly. So let's transition to the economy and policy, and we're going to start with the Federal Reserve and Kevin Warsh and his announcement of the task force
Yeah, so you have the new Fed,
forces
what we'll call the forces.
forces.
Um, we have the new Fed, and the new Fed is taking a deeper dive into paper data, and it's reaching out into other areas to get things right, to have a better understanding of what they're doing, why they're doing what they're doing, and who they should be talking to, who are the specialists in all these different areas. They're just taking a deeper dive. I think this is a very good thing. Um, at the same time, you have the Fed, this new Fed, talking about maybe viewing inflation a different way
Mhm.
and maybe not being held to forward guidance. Like, let me tell you where I think this will be 5 years from now.
Right,
Right. And that's good because they're trying to remove bias and they're trying to remove ego from the decision making at the Fed, which we have seen happen pretty substantially for
right,
some time. So, in lieu of no Fed forward guidance, here's your forward guidance. And this is what we look at. This is the bond market. You have let's call it the tip spread, the spread between the 5-year, 10-year, 20-year Treasury inflation protected securities versus the corresponding Treasuries. And what you see here is the spread, which reflects or indicates the long term, short term and long term view of inflation tends to be somewhere between 2 and 2.4%. So we love this because this is where money is changing hands.
Hmm.
So if you're betting on inflation, uh, you have both sides weighing in, buyer and a seller, and this is a big money market. This is the view of the bond market as to where inflation will be 5, 10, and 20 years out.
This has historically been a pretty good gauge.
A phenomenal gauge.
Yeah, absolutely. Okay.
Phenomenal gauge. So here's
And
your forward guidance.
and one more step in regards to the inflation conversation. He's now talking about trimmed inflation.
Yeah, trimmed inflation, if you just think about it, you have all these categories. This is my simple explanation of it. You take out all the most volatile readings from the month, therefore the quarter, and you look at everything else. Just
Hmm.
knowing that all the data is going to have, some areas that uh, rise for whatever reason. Maybe there was a hurricane somewhere. Maybe there was a policy change in California, and
Hmm.
property insurance nationally registered a higher number because of one or two states. So what you do is you trim off the hottest and coldest, most volatile data sets, and you look at the rest of the data, and then you measure it that way, knowing that those items will come back into the middle at
Hmm.
some point. And it makes a lot of sense because you don't want to change monetary policy because of a
Short
short-term
term.
spike in oil
Yeah.
or a short-term spike in FEMA claims or a short-term spike in, auto insurance premiums because of a policy change in a major metro area.
Right.
Right? So, uh, I believe this is a great way to view inflation, and what you see, whether you look at the 1 month, inflation reading, 6-month trailing, 12-month trailing, they're all in the 2s. So, we believe that this Fed will see no reason to hike interest rates, um, because of the way that they will likely be viewing inflation as
Absolutely.
a whole, not each individual.
Hmm. Yeah. And I think this is a great point because there are a lot of individuals, investors that still believe that inflation is fairly high.
Yeah. Well, I mean,
Oh.
so if we go to the next slide,
Yeah.
something else that proves the point is the Strait of Hormuz traffic is returning to normal.
Yes.
So you see, the left side all the way to mostly the right side of this chart, a very depressed amount of vessels crossing the Strait of Hormuz, and then as of the past 10 days or so, uh, you know, just about back to normal, right?
Huge difference.
Things change quickly. What
Yes.
happens when that happens? If you go to the next slide,
Yep.
yeah, the price of oil is now back to where it was before the Iran war,
Complete
literally
reversal.
exactly back to where it was. So if the main creator of short-term inflation rising a little bit was higher oil
Hmm.
prices, and you start to hear things like the Fed should hike, the Fed should hike. Well, what happens when now suddenly you blink your eyes and the price of oil is back to where it was on March 1st?
Correct.
This is why trimmed inflation makes a lot of sense. You don't want to set monetary policy based on, short-term spikes in various commodities.
Yeah.
Yeah.
Absolutely.
So,
And let's spend a moment talking about the evolving market and job market, excuse
yeah,
me.
from an employment standpoint,
Yeah.
this one stood out to us. You look at the year-to-date change in jobs, and really the subsectors of where jobs are and aren't. And what stood out to us was there's a lot of electrical engineering, industrial engineering, mechanical engineering, IT infrastructure, um, scientific research and development, development, and human resources. All of that means economic growth,
Hmm.
right? Um, I should point out that when you see a lot of government jobs, that's not usually nearly as productive as maybe some of these wide economic moat jobs.
Right.
So again, clearly the result of the tax and spending bill and the opportunity and the willingness of companies to deploy capital to hire these people and to spend money and to, do economic moving, positive economic moving things.
Mhm.
So this is a very good sign.
Good sign. And Bob, what do you say to the comment of, well, AI is taking all of our jobs?
So we've been saying for a while, just as we thought through the whole process, that AI should create more jobs and more opportunity. And this chart actually proves it out.
Uh-huh.
So look, I think if you're a business, you want to deploy AI, you want to pair a human with AI. Generally speaking, in most industries that I could think of, there should be some incremental improvement in output, productivity, quality, accuracy, right?
Mhm.
Otherwise, why are these companies spending money?
Yeah.
And with that, it just creates more opportunity to do more, learn more, be more effective, and that's kind of what you see here,
Hmm.
right? So you
Amazing.
have a comparison on these slides that shows all jobs on the left. The high AI adoption, you have about a 10% increase in all jobs. Low AI, even low AI adoption, there's you know,
Marginal.
it shows no change, but it's a marginal increase.
Hmm.
On the right hand side, entry level, where we actually thought it would be devastating to entry level jobs. So if there was an area that we thought AI would just wipe out jobs, it was entry level stuff. But actually, what you're seeing is the opposite.
Yeah.
With high AI adoption, there's just a huge, huge, huge increase in headcount.
Yeah.
Yeah, fascinating. So again, if you really think about it, if we all had an assistant to make us better, more efficient, that assistant was generally speaking a genius, and they could give you responses very quickly and help you be more efficient. Um, that's a good thing.
I can only imagine.
Yeah, yeah. So we shall see.
Yeah.
Everyone
And
should know that Julina is a power user of AI. By the way,
mhm,
yes, something we'll cover maybe in future months.
I'm learning. Yeah.
Okay,
It's
learning.
been it's been
You're
a
a professional.
transition over the last year.
Yeah.
Let's transition to market anomalies, and we title this Casino Royale. We're going to talk about some of the leveraging in the market.
Yeah. We have brick and mortar casinos. We have online gambling. We have props bets with Kalshi and Poly Market, where you can bet on, I don't know, the weather tomorrow. You can bet on how many red T-shirts the World Cup stadium attendees are wearing. Stupid stuff. If that's not enough action for you, you can invest in very levered exchange traded products holding various securities with derivatives in the market. Oof,
Mhm.
awful. Again, this to me just becomes an addiction. I think if you're using these products, you have problems. Um, and it shows that there are more assets
Yeah.
being flowed into these products, which I must tell you in the short term, right, Julina, we've seen that they create bad days and bad weeks. And so when you think about the bad days in the market, what did I miss? What happened? What's going on? It's usually now these get blown up, these products,
Mhm.
because there's betting on the long side of the market. There's leverage saying, hey, if you buy this package of securities, we can add 2, 3, 4, 5 times leverage. So why settle for a 2% weekly return when you can get 12% a day?
Right.
People forget that there's also downside though. So leverage works to the upside and the downside.
Yes.
And then you have products that bet in the other direction with leverage.
Mhm.
So oftentimes when there's no news or nothing going on, and all of a sudden, let's say the semiconductor part of the market, 4 of the companies start selling off like crazy, it tends to be these products blowing up.
Right.
So I don't think this is a safe space. I hate to see this. Again, this is just a trend of if gambling isn't enough for you, take it to the market. And, there's some provider of some packaged product that is willing to throw a fee on it and
Yeah.
charge you to, waste your money.
I mean, these products have been around for a while. It's just the fact that they've quadrupled, in the last 5 or 6 years. It's a great example of FOMO, right? It's
Yeah.
just the markets have done very well, and I think that there's a lot of individuals that have this fear of missing out, and this is one of their ways of trying to participate.
Yeah. This is, it's playing with dynamite, which
Yeah,
I don't really love to see.
right.
Yeah.
Absolutely. And what about gold? This is another topic that's top of mind with a lot of investors.
So we've long been saying, look, it's okay to have a small allocation to gold. We generally have it buried through some multi-asset investment for our client where you don't even see it outright typically. I mean, our view is there are other stores of value out there. And from time to time, the major price swing is driven by sovereign wealth funds ramping up or buying up some of the available gold to help stabilize their currency.
Hmm.
And they usually do it in a pattern, monthly, quarterly, sometimes weekly for a certain period of time. But then when they reach their allocation, they stop. But then what it does is it attracts retail investors saying, oh, we missed out on something. Something's happening. Something's happening. Go
Hmm.
to the charts. This is what's happening, so on and so forth. But we've been saying, well, wait a second. Gold owned in ounces really hasn't changed. So it's just a shuffling around of the gold,
Yeah.
right?
What gives?
So what gives? What gives is the speculate. It's just a speculative asset class. And the only thing that has changed is price. If price is changing because of the total ounces of gold being bought and owned by everyone rises, then obviously you have a real fundamental
Hmm.
scenario where gold provides potentially a lot of value. What we have seen over the past few years is a wild run up of gold, not on the back of more ounces owned, but simply speculation. A lot of these levered derivatives,
There
right?
you go.
Betting on the future price. It's almost become oil,
Yeah.
right?
Yeah.
So this is why we're just not in love with over owning gold because it tends to be mostly speculation.
Hmm.
And we were talking before, people forget about the long bear markets that gold goes through
Yes.
and will go through,
Yeah.
in addition to the long bear markets that it goes through. But you had a great quote, if you don't mind mentioning it.
Yeah. Well, what's interesting is that it is Michael Semblist here, who actually shared this information from JP Morgan. He wrote a white paper, I think earlier this year, very, very detailed, going back all the way back to the 1900s, very long term. Gold historically gives you the return of the bond market, but it gives you the volatility of the stock market. And to us, that's not a really good long term
Yeah.
asset class
And
relative
no
to.
dividend,
Exactly.
no dividend.
Exactly. So
It's
I just think that
all
it's
price.
fascinating that he followed up with this.
Yeah. So very good chart, something to be mindful of for the gold bugs out there.
Yep, absolutely. And a couple points on the everything else topic. We have a great wealth transfer in action as we speak. It's been going on. And when we talk about the great wealth, we're talking about what 124 trillion of the silent and baby boomer generations, which are the red and blue highlighted here, as you start to see that start to wane and move into the Gen X and millennials on the upper right hand side of the page.
Yeah, what you really see is money is being inherited by the right side
Hmm.
coming from the left side. And as the silent generation, in essence, dies off, the baby boomers, Gen X, and millennials start to rise. As baby boomers start to die off, the Gen X and millennials continue to rise. We think in 10 years, this chart will look quite different.
Massively different.
Yeah, the green and purple up top will be a much wider part of this chart as the red really starts to just disappear.
Yeah.
Um, and the rest will be the bluish purple, which is baby boomers.
Yeah.
Just to show you how significant the sum of wealth is for baby boomers, this chart does a really good job of explaining it.
Yeah. Absolutely. And one last slide. Hold on. I am going to see if I can multitask. Ready?
Yeah.
Here you are.
Hey, happy birthday, America.
Happy birthday.
How about that? That was great. We're going to take those sound effects out of your hands soon.
Okay.
Yes. So, a little bit of an ode to America here. We are 4% of the global population. We are 27% of the world's gross domestic product. 83% of the top 100 firms by market cap are here. 88% of the top 50 sports franchises, 98% of the 50 all-time highest grossing movies. There's some interesting information, some superficial information on this chart. In addition to the fact that people are willing to risk their lives and their kids' lives to come to this country. It's a wonderful country. It's the people that make it wonderful. And I believe it will be wonderful, certainly for the rest of my life, definitely for my daughters, and hopefully beyond that. So
Yeah. Yeah. And I have to say, and I'm sure I'm not the only one that can say this, but having lived abroad. I grew up in South America for a lot of my childhood. We should be so proud to be living in this country. So, and I have a father and my grandfather. They both served in the Air Force. So, thank you, of course, to all that served as well.
absolutely.
So, thank you, Bob, for the insight. As always, any last comments as we go through the summer? And of course, we'll be back in August for another update.
Yeah, I mean, some very simple advice: wear sunscreen. It's very likely hot out there wherever you are watching this. Take care of your skin. The bad effects of not taking care of your skin show up many moons later, and when they do, sometimes it's not a good scenario. So take care of yourself, hydrate. Hopefully everyone has a nice long life to live. Do what you need to do to stay healthy, and certainly take care of yourself.
Thank you again, Bob. And as always, to everyone listening, we appreciate your time. If you have any questions, concerns, please feel free to reach out to any of us at Principal Wealth. Enjoy your summer.